If I could only trade 3 setups for the rest of my career, these are the only strategies I'd rely on. And in today's video, I'm going to share them with you. My top 3 smart money concepts trading setups. Each setup is built on solid mechanical rules with real market logic behind it, and each has the power to skyrocket your win rate when applied correctly. Make sure you watch until the end, because the last setup is the most effective one, and you definitely don't want to miss it. We always appreciate your support, so please give this video a thumbs up and subscribe to our channel if you are new. Welcome back, traders, so let's get started. The first powerful setup is built around revisiting a liquidity sweep area and the classic fair value gap. In the bullish scenario, this setup plays out when price returns to a zone that price already swept sell-side liquidity of a key level before, such as the lows of a key demand zone, a major low, or a cluster of lows, and then shows a clean rejection. Once price taps into the liquidity sweep's order block, the price usually reverses sharply and continues in the upward direction, resuming the bullish trend. On the flip side, in a bearish market, the exact same concept applies, just in reverse. Here, the setup plays out when price revisits an area where buy-side liquidity has already been swept, such as the highs of a key supply zone or a cluster of equal highs. A swift rejection from that level sets the stage for a drop, confirming the continuation of the bearish trend. Now you might ask, what makes this setup powerful? The logic behind this setup is simple, but very strong. Smart money usually pushes price near the key areas in order to manipulate the market and traders to generate enough volume for itself to execute its orders. And usually it does that with a quick move that sweeps below or above a key level, followed by a sharp and quick reversal move in the opposite direction. So, these zones are where smart money first enters their positions. They're manipulation areas that form before the main institutional orders are executed. That's why they carry so much weight. Price tends to respect them. So, when price comes back to these zones, institutions often step in again to defend their positions or initiate the remaining portion of their trades. That's exactly why we wait for the price to revisit these zones. To get the best results with this trading plan, you'll need to work across 2 different time frames. First, use a higher time frame to analyze overall market conditions and to spot liquidity sweeps along with the order blocks tied to them. The most effective higher time frames for this setup are the 30-minute and 15-minute charts. Then, once you've identified a potential setup, zoom into a lower time frame, like the 5-minute or even the 1-minute chart, to look for confirmation signals and precise entry points. Here's the breakdown. If you're analyzing on the 30-minute chart, drop down to the 5-minute chart to confirm reversals and find your entry. If you're working with the 15-minute chart, then shift to the 1-minute chart for confirmation and entries instead. The beauty of this setup is that it works effectively in both scenarios. It's just about choosing the time frames that fit your style and sticking to them with consistency. Now, let's break down the details of the first trading setup. In the bullish scenario, the first step is to spot a valid liquidity sweep on a higher time frame, like the 30-minute or 15-minute chart. You're looking for the price to take out a key level, immediately reverse, and then confirm with a break of structure. Once that happens, you need to mark out the order block that initiated both the liquidity sweep and the break of structure. That's your higher time frame point of interest, and more often than not, price will revisit this block, acting as a demand zone where smart money steps back in. After marking the block, the next step is to wait for the price to retrace into it. That's where your trading opportunity lies. Now, when price comes back into your order block, you have 2 entry approaches depending on your style. Conservative and aggressive entry. Let's start with the conservative entry method. Once price returns to the higher time frame order block, we zoom into a lower time frame, like the 5-minute or even the 1-minute chart, and look for signs of reversal. This could be a market structure shift or a clear change of character, which gives us our first layer of confirmation. Now, once that structure shift is confirmed and we expect the price to move higher, the next step is to look for a buying opportunity. At this stage, we focus on spotting a bullish fair value gap that forms within the market structure shift leg. These zones often act like magnets, pulling price back in before it continues upward. To execute the trade, we place a buy limit order at the midpoint, or 50%, of the bullish fair value gap on the lower time frame. For the take profit, we target the higher time frame buy-side liquidity, which gives us a precise and high probability setup. However, in the second entry method, the more aggressive approach, once the price taps into the higher time frame order block, the next step is to zoom into the lower time frame. Here, we're looking for a violated fair value gap that transforms into an inversed fair value gap. That's your first confirmation. Once this inversed fair value gap forms, it's likely to hold as a new support zone, giving us a solid entry point for a buy position. If a market structure shift also occurs at the same time, that adds another powerful layer of confluence, strengthening the setup. With these confirmations in place, we can expect the price to retrace into the inversed fair value gap before continuing upward toward the next buy-side liquidity. At this stage, you'd place a buy limit order at the midpoint of the newly formed inversed fair value gap, with your take profit targeting the nearest higher time frame buy-side liquidity. The same concept applies to the bearish scenario. One important tip: if you're trading with the 30-minute and 5-minute time frame combination, both conservative and aggressive entries work well. But if you're working with the 15-minute and 1-minute combination, the aggressive entry approach tends to be more effective. Now let's put everything together and go through a real chart example to see exactly how this strategy plays out. On the screen, we have the US dollar Swiss franc 1-hour chart. As you can see, after price swept the sell-side liquidity below this 1-hour swing low, it immediately returned back into the range, quickly shifting direction and pushing to the upside. If we zoom into the 30-minute time frame and look more closely, we can see that after forming a valid liquidity sweep, price also created a bullish break of structure by breaking and closing above the most recent swing high. So, everything we were looking for is here. A valid liquidity sweep, followed by an immediate reversal in the opposite direction, and a break of structure on the 30-minute chart. The next step is to focus on the origin of this bullish expansion, the exact move that caused both the liquidity sweep and the break of structure. For that, I'll highlight this down close candle, the opposite color candle, which forms the 30-minute order block and has the potential to reverse price. This leaves us with a fresh, unmitigated demand zone. And this is exactly where we want to keep our eyes. It's an ideal area to look for long opportunities if price pulls back into it. Once we've identified the higher time frame order block, the next step is to wait for the price to tap into it. Now let's play the chart forward to see what happens. As you can see, price pushed downward and eventually taps into the zone and shows rejection. Next, I zoom into the lower time frame, in this case, the 5-minute chart, to closely monitor price action within the 30-minute order block zone, and look for any signs of reversal and a suitable entry point for a long trade. Now, on the 15-minute chart, you can see that after price tapped into the higher time frame order block, it reversed and formed a market structure shift by breaking and closing above this 5-minute structure. This tells us that the selling momentum is fading, and buyers are stepping back in. Once the bullish market structure shift is confirmed on the 5-minute chart, we expect the price to push higher. The next step is to look for an entry point for a long trade. Now, if you look closely, you'll notice that price has formed a bullish fair value gap within the market structure shift leg. This area often acts like a magnet, drawing price back into it before continuing to the upside. With all the rules and conditions now in place, I'm taking the conservative entry approach, setting a buy limit order at the midpoint of that 5-minute bullish fair value gap, and targeting the most recent 30-minute buy-side liquidity as my take profit. Now, let's play out the trade and see what happens. As you can see, my long order has been triggered, and then price shifted direction, pushing higher exactly as expected, and eventually hit the TP. Now let's move on to the next trading setup. The second setup combines supply and demand concepts with the classic fair value gap model, breaker blocks, and mitigation blocks, creating a powerful trading plan that has the potential to be your only setup to become a consistently profitable trader. This strategy works with 2 time frames: a higher time frame to analyze market conditions and identify high-quality supply and demand zones, and a lower time frame to zoom in for confirmation signals and precise entries. My recommended combinations are the 1 hour with the 5-minute or the 4 hour with the 15-minute. Of course, you can use other time frames as well, but the key rule is that your higher time frame should always be at least 2 levels above your entry time frame. Also, keep in mind that supply and demand zones on the 4-hour and 1-hour charts are far more reliable, and price is much more likely to respect them. Now let's break down the details of this trading setup and see exactly how to execute trades with it. In a bullish scenario, the first step is to confirm that price is in an uptrend and that buyers are in control of the market. To do this, you need to identify at least 2 successive bullish breaks of structure. Once that happens, shift your focus to the most recent bullish break of structure. From there, trace back to the origin of the bullish expansion move, the move that initiated the break. This origin point is what forms the demand area. The next step is to highlight the most recent unmitigated demand zone on the higher time frame. Then, wait for price to return to that zone. Once price taps back into it, zoom into a lower time frame, such as the 15-minute or 5-minute chart, and monitor closely for signs of reversal. That will serve as your first confirmation before looking for an entry. This could be a market structure shift or a clear change of character. Either way, that serves as your first layer of confirmation. This market structure shift signals that the temporary bearish move is ending, and bullish momentum is likely coming back. At this point, the price is expected to realign with the trend of the higher time frame. Once the bullish market structure is confirmed and we expect price to move lower, the next step is to look for a buying opportunity. At this stage, we have 3 different entry approaches to open a position. In this case, a buy position. Each method has its own pros and cons. The classic fair value gap model, the mitigation block, and the breaker block. These areas often act like magnets, attracting price to retrace into them before continuing upward. So in the first entry method, once price taps into the higher time frame supply or demand zone and forms a market structure shift on the lower time frame, we then look for a bullish fair value gap that forms within that market structure shift leg. That's where we open a buy position on the lower time frame. For the take profit, you can target the nearest liquidity pool on the current time frame, or aim for higher time frame key levels if you're looking for a larger move. Similarly, in the second entry approach, after price taps into the higher time frame supply or demand area, if it forms a mitigation block on the lower time frame, that gives us a strong opportunity to go long. For a bullish mitigation block to form, price first needs to create a swing low, then a swing high, followed by a higher low. After that, price should make a market structure shift with a bullish displacement leg that closes above that swing high. In this case, your bullish mitigation block will be the up-close candle, or series of up-close candles, formed between the first low and the first high. To execute a long trade, you can place a limit order at the highest point of that mitigation block and wait for price to activate it. Note that this is different from a breaker block because with a breaker block, we look for a lower low to be formed, not a higher low. So in the third entry method, we are looking for a bullish breaker block to form inside the higher time frame supply or demand zone. For a valid breaker block, price needs to first create a swing low, then a swing high, followed by a lower low. After that, we should see an immediate expansion move in the opposite direction that produces a market structure shift. In this scenario, the up-close candle, or series of up-close candles, formed between the first swing low and swing high, will mark your breaker block area. That's the zone you can use to open a long position. The exact same concepts apply to bearish entry methods, just in reverse. Now let's break down this trading setup with a real trade example. Here we have the Euro-Dollar 4-hour chart on the screen. As you can see, price is in a strong downtrend, and bears are clearly in control, since the market has already created multiple bearish breaks of structure, more than 2 for sure. This tells us that the expectation is for the price to continue lower, and our focus should be on looking for short opportunities. The most recent bearish BOS is located right here. At the origin of the move that caused this BOS, we can see an unmitigated supply zone. So I'm going to highlight these 3 up-close candles as my supply area. This gives us a fresh supply zone, and this is exactly where we want to keep our eyes, because it's an ideal area to look for short opportunities if price pulls back into it. The next step is simply to wait for price to tap into this 4-hour unmitigated supply. Now let's unfold the chart and see what happens next. As you can see, price pushed higher and tapped directly into the 4-hour supply zone. So now, all the criteria we were looking for are in place. A strong downtrend with multiple bearish BOSs, a clear break of structure on the 4-hour chart, and a fresh, unmitigated supply zone formed at the extreme, now tapped by price. Now everything looks perfect, so I'm going to zoom into the 15-minute time frame to monitor the price action inside the 4-hour supply zone and identify a suitable entry point to go short. With the 15-minute chart on the screen, you can see that after tapping into the higher time frame supply, the price reversed and formed a clear market structure shift. At the same time, it created a breaker block, represented by these two down-close candles. Notice the sequence here. Price first formed a swing high, then a swing low, followed by a higher high. But immediately after, it reversed direction and closed below those down-close candles. This behavior confirms the breaker block, giving us another strong layer of confluence for a short entry. With these confirmations in place, we can anticipate that the price will return to the breaker block zone before continuing its move toward the sell-side liquidity. So here's my plan. I'm setting my entry at the lowest point of the breaker block, with my stop loss just a couple of pips above the higher high. For the take profit, I'm targeting the sell-side liquidity below this swing low, which gives us roughly a 4-to-1 risk-to-reward ratio. Now let's play out the chart and see how this trade unfolds. As you can see, the order was triggered. After a brief drawdown, price reversed, pushed lower, and eventually hit the take profit, exactly as expected. Now, let's move on to the third trading setup, one that has the potential to skyrocket your win rate. This 5-star setup combines the classic fair value gap model with liquidity sweep, creating a high probability strategy when applied correctly. In a bullish market profile, this setup plays out when price sweeps sell-side liquidity, such as the lows of a key demand zone, a major low, or a cluster of lows, right before tapping into an unmitigated bullish fair value gap. Once the fair value gap is filled, the price usually reverses sharply and continues in the upward direction, resuming the trend. Similarly, in a bearish scenario, the setup occurs when the price sweeps buy-side liquidity, such as the highs of a key supply zone or a group of highs, and then taps into a bearish classic fair value gap. In both cases, the core element is that liquidity is swept immediately before the gap is filled, which creates a strong reaction zone for the price. What makes this setup powerful? The psychology behind this setup is simple, but very effective. The magic happens when the market clears out liquidity and mitigates the fair value gap at the same time. When the market sweeps liquidity near a key area, like a lower high, and simultaneously mitigates a fair value gap, it removes two forms of sell-side or buy-side pressure: the liquidity void of the fair value gap, the stop-loss orders of early traders who entered prematurely. This clears the path for the market to move decisively toward the next liquidity pool in the direction of the trend. So, in a bullish market, once price sweeps the lows and fills the FVG, there's no more sell-side liquidity left to grab. That increases the probability of a sharp move toward buy-side liquidity, aligning with the overall bullish narrative. This is exactly what makes this strategy so effective. It's not just technical, it's rooted in market logic. To take advantage of this high-probability trade in a bullish scenario, the first step is to identify a higher time frame liquidity sweep. Once you spot that, wait for price to tap into the higher time frame fair value gap immediately after the sweep. When that happens, zoom into the lower time frame to carefully see how the price reacts inside that higher time frame gap. You want to look for clear signs of rejection or a market structure shift. That's your first layer of confirmation before planning your entry. The next step is to identify either a breaker block, a mitigation block, or a lower time frame fair value gap that forms within the market structure shift leg. That's where you look to open your position. This strategy also uses two time frames. I usually combine the 1 hour with the 5-minute chart, but you can also use 4 hour with 15-minute or even 15-minute with 1 minute. The key is that your higher time frame should always be at least 2 levels above your entry time frame. Now let's see how this setup plays out with a real trade example. Here we have the Euro-Dollar 1-hour chart on the screen. The overall market profile is bearish. And as you can see, price swept the buy-side liquidity above multiple swing highs, then tapped into this 1-hour bearish fair value gap. After filling it, the price showed rejection, so all the conditions for this setup are met, making it a perfect selling opportunity. Since we now have the confluences we were looking for, the next step is to zoom into the 5-minute time frame. Here, we'll look for reversal signals such as market structure shifts and identify a suitable entry point to go short if everything aligns. Now, with the 5-minute chart on the screen, we can see that after tapping into the higher time frame fair value gap, price reversed and formed a market structure shift. At the same time, it created a breaker block, represented by this down close candle. Price formed a swing high, then a swing low, followed by a higher high, before immediately reversing and breaking below that down close candle. With these confirmations in place, we can anticipate that price will return to the breaker block zone before continuing its move towards sell-side liquidity. So I'm setting my entry at the lowest point of the breaker block, with my stop loss a couple of pips above the higher high. For the take profit, I'm targeting the sell-side liquidity below this swing low, giving us roughly a 5 risk-to-reward ratio. Now let's see if our trade plays out successfully or not. As you can see, my order has been triggered and price pushed lower with great momentum and eventually hit the TP. That's it, traders. Thanks for watching. I hope you found this video valuable. If you did, hit subscribe and turn on notifications so you never miss an update. Drop a comment below with your thoughts or topics you'd like to see next. Your support means the world to us. See you in the next video.